Remember when you got your first paycheck as a teenager? The excitement of seeing the direct deposit or receiving that first check, frantically tearing open the envelope to behold the payoff for all your hard work, and then you look down and see the check amount was way smaller than you had calculated? You're dumbfounded. Why is 20% of what I earn going to something called FICA and Social Security? Well, congratulations, young Subway sandwich artist. You've just discovered taxes. It gets even better when you receive this here W-2 form that shows just how much of what you earn the whole year is not given to you and is instead withheld for income tax. Maybe Uncle Sam will be so generous as to give you some of it back, like your dad giving you a single Oreo from the pack you went to the store to buy. Now, much as it pains us to admit it, taxes are a necessary part of civilized society. Even the founding fathers, who revolted against the British partially because of what they considered to be unfair taxes, found themselves sending troops to western Pennsylvania to put down revolts against a tax on distilled spirits. This is commonly known as the Whiskey Rebellion. This doesn't mean, however, that people don't try to get out of paying taxes as much as possible. It is not illegal to try to avoid or reduce the amount of taxes you pay. The Supreme Court has made that clear. However, the IRS is unsurprisingly zealous when it comes to investigating and collecting every last cent that it is owed. It is necessary to do this, but that doesn't mean we have to like it, and people come up with many creative schemes to reduce their tax burden or outright evade taxes. The NBA, and the gifted athletes who play in it, are no stranger to scandals involving money and schemes to illicitly keep their hard-earned income. I wouldn't call the 1982 United States tax court case Johnson v. Commissioner a scandal for former Warriors and Wizards player Charles Johnson, but the case certainly provides a glimpse into the lucrative world of tax avoidance and evasion. Mr. Johnson probably should have gotten a better financial advisor or tax attorney to avoid this classic example of a disallowed assignment of income scheme. This attempted scheme led to him paying the equivalent today of around $600,000 in additional income taxes, plus legal expenses. So, let's find out how Mr. Johnson ended up in court and what his tribulations can tell us about the fascinating world of federal income tax.
Great. This is gonna be fun.
For those who don't know, and that included me before I read this case, Charles Johnson played point guard for the Golden State Warriors from 1972 to 1978. He must have been pretty good, at least I assume. To be honest, I don't really watch basketball, but he was a two-time NBA champion. That counts for something, right? During the summer of 1974, after completing the season, Mr. Johnson followed the advice of an unnamed friend and contacted an attorney named Robert L. Dunnett. All I could find about Mr. Dunnett was that he graduated from UC Berkeley in 1969 and used to practice in the Bay Area. Mr. Dunnett and Mr. Johnson attended Berkeley during the same time, so perhaps they were acquainted with each other. Or maybe Mr. Dunnett was just known for giving his clients some extra help with their tax planning. Mr. Dunnett and Mr. Johnson came up with a plan to reduce Mr. Johnson's tax burden. On August 16, 1974, Mr. Johnson signed a contract with Presentaciones Musicales, or PMSA for short, which was a Panamanian corporation. The agreement stated that PMSA had the right to control Mr. Johnson's services in professional sports for 6 years and required PMSA to pay $1,500 a month to Mr. Johnson. That's the equivalent to about $10,000 a month today. A few days later, that agreement was licensed out to EST International, a British Virgin Islands LLC. Basically, EST paid expenses, made the monthly payments to Johnson, and had to give PMSA 95% of the net revenue collected under the contract. When it came time for a new contract between the Warriors and Mr. Johnson, Mr. Dunnett represented Mr. Johnson. The Warriors refused to have a licensing contract, instead insisting that Mr. Johnson sign an NBA uniform player contract. That contract, signed on August 27, 1974, covered the 1974-75 and 1975-76 seasons and paid Mr. Johnson $45,000 and $55,000. That's the equivalent in today's money of around $295,000 and $331,000, respectively. Although the Warriors refused to sign a contract with anybody other than Mr. Johnson, they did agree to send the payments under the contract to someone other than Mr. Johnson. In April of 1975, Mr. Johnson assigned all the contract payments to EST. On May 28, 1975, the Warriors would win the NBA Finals 4-0 against the then-named Washington Bullets, who are now named the Washington Wizards. Mr. Johnson received quite the pay raise from this victory. His next contract with the Warriors, signed on September 15, 1975, now saw Mr. Johnson receiving $85,000 for the 1975-76 season and $90,000 for the 1976-77 season. This is equivalent to around $512,088 and $512,671 in today's money, respectively. On a side note, you can see how much of a problem inflation was in the late 1970s. Mr. Johnson receives $5,000 more year over year, but his salary ends up being worth essentially the same. If you don't already realize this from, say, the past 6 years, this perfectly illustrates why people despise inflation. In September of 1976, PMSA agreed to increase the monthly amount paid to Mr. Johnson to $2,000, probably to account for inflation and the increase in Mr. Johnson's compensation from the Warriors. 5 months after signing a contract with the Warriors covering the period from 1977 to 1980, Mr. Johnson signed a contract to play for the Washington Bullets on January 30th, 1978. This contract had a similar structure to the previous Warriors contracts, and it is unexplained why Mr. Johnson left the Golden State Warriors for the Washington Bullets. Mr. Johnson would play for the Bullets until 1979, when he left the NBA, and would assist the Bullets in winning the 1978 NBA championship. Now, that's all well and good hearing about Mr. Johnson's story, but what does this have to do with tax evasion and court proceedings? Well, on his federal income tax returns for 1975, 1976, and 1977, Mr. Johnson reported no salary, instead reporting the monthly EST payments as business income, which is taxed differently. For some reason, the IRS decided to set its mighty eye on Mr. Johnson and decided to do a little review of his financial situation. While reviewing Mr. Johnson's tax returns, the IRS determined that all the amounts paid by the Golden State Warriors to EST for Mr. Johnson's basketball services were in reality income to Mr. Johnson and not income to EST. Therefore, Mr. Johnson was given a notice of deficiency, a statutorily required notice from the IRS stating that they believe you owe them more money. The IRS then increased the amount of Mr. Johnson's taxable income by a total of $198,281 over the 3 years from 1975 to 1977. That's the equivalent today of around $1.1 million. Remember as well that this was before the tax cuts of the 1980s, and tax rates were much higher. Based on the tax brackets for the tax year 1977, Mr. Johnson had a tax rate of almost 70% on any income above $82,200. He was making $90,000 for the 1976-77 season. For comparison, the highest tax rate for the 2025 tax year was 37% on income over $626,000. This would have been over $100,000 in 1977 money. This is why the increase in Mr. Johnson's income of $198,281 over 3 years led to an increase in his tax bill of $111,277 over the same 3 years. In today's money, that's paying around $591,000 in taxes for a $1.1 million increase in income. As you can imagine, Mr. Johnson was probably less than pleased by getting that letter from the IRS. He probably also did not want to pay that tax bill. Luckily, he can challenge that determination in court, a special court dedicated to tax disputes. The U.S. Tax Court has been around in some form since the 1920s, and is a dedicated forum for American taxpayers to challenge IRS tax determinations before having to pay the disputed tax amount. You can also challenge tax determinations in a regular federal district court, but you must pay the disputed amount before suing in those courts. This is because if you have not paid the tax amount yet, you have technically not been injured by the government until you do. There are numerous differences between the tax court and various criminal and civil courts like U.S. district courts. These include differences in how judges are appointed and the lack of juries in the tax court. The tax court, however, still conducts trials and works basically like a regular American court. I'm sure only the most exciting of trials occur in a tax court. Regardless, there's not much publicly available about how the trial went. One fun fact, however, one of Mr. Johnson's lawyers, one Harry Margolis, was apparently embroiled in a tax fraud trial in 1977. According to this trial, he used offshore tax havens to create fictitious tax deductions for clients like singer and actress Barbara McNair and Olympic diver Sammy Lee. He was acquitted of all these charges, however. Now, I don't know about you, but I'm not entirely sure that I would want to have a lawyer accused of tax fraud to be the one representing me in a case where I'm fighting the IRS's determination that I did not pay my true tax liability. It seems like it might not be the best optics before the court. However, Mr. Margolis was acquitted, so maybe he was really good at hypothetically helping his clients get out of paying the full amount of taxes they should pay under the law. Unfortunately, Mr. Margolis's hypothetical skills were not successful in helping Mr. Johnson out in this instance.
My client should go right to jail! The son of a is guilty!
On June 7th, 1982, Judge Fay of the U.S. Tax Court issued his decision. The main issue, around which the whole case revolves, relates to payments made by Golden State as compensation for Mr. Johnson's services as a basketball player. Were these monetary payments income for Mr. Johnson, the guy who earned the money through playing basketball, or are they income for EST, who received the payments and benefited from them? Mr. Johnson and EST's scheme implicates something called the Assignment of Income Doctrine, a judicial doctrine created by the U.S. Supreme Court in the landmark 1930 case Lucas v. Earl. The doctrine was created in order to prevent people from reducing their tax burden by moving his or her money around to other people or entities, aka assigning his or her income to others. In Lucas v. Earl, for example, a husband and wife contracted to split all earnings and property between the two of them. Because of this contract, the husband only reported half of what he earned to the government for income tax purposes, as he considered his wife to own the other half. These attempts to assign income were common when there were more tax brackets and tax rates were much higher. Income tax rates are imposed on the money earned past a certain amount. So for 2025, if you earn an income of $50,000, your tax rate is 10% for the first $11,295 you earn. We will ignore all the tax credits and filing minimums and deductions and all that crap for now. After that, every dollar you earn between $11,925 and $48,475 is taxed at a rate of 12%. That leaves you with around $1,500 to get you to $50,000. That $1,500 is then taxed at a rate of 22%. As you can see, minimizing the amount of income you have to report will mean that you don't have to pay the higher rates. If you earn that same $50,000, but then split it with your wife or child or next door neighbor or anybody, and then only report $25,000 to the government, both of you only have to pay the 10% and 12% rate. If you do the math, like I did, the same $50,000 split in two can save you $302.80 purely in income tax. That's enough extra cash for you and your wife to have a 5-night vacation at the Motel 6 by the Louisville airport and buy a 12-pack of Busch Light with room to spare, maybe for a scratch-off or two. Smart money, you see. These savings were even larger when tax rates were higher and there were many more tax brackets, so trying to assign income like this was very popular. The Supreme Court, in order to protect the holy sanctity of the income tax, ruled that assigning income like Mr. Earl did not matter for income tax purposes. Instead, income from services is taxed to the person who earned the income. You can contract for any amount of the money you earn to go to someone else, but since you went to work every day to earn it, you are the one who pays tax on it. The court uses an agricultural metaphor. The fruit from a tree cannot be attributed to a tree that the fruit did not grow on. The IRS claims that Mr. Johnson's arrangement with EST is an example of an assignment of income scheme. Mr. Johnson was the one who earned the income from playing basketball, so he should be the one to pay the tax on it. Since we are dealing with corporations and the business world, Judge Fay recognizes that simply applying Lucas v. Earl and finding that Mr. Johnson was the true earner because he was the one dribbling the ball is not fully workable. We are dealing with a corporation, EST, which is its own taxable entity and makes its own corporate income. If you don't already know, corporations such as LLCs are treated as a separate entity from the owner. They can enter into contracts and be held legally liable without finding the owners personally liable. Along with these powers, corporations have the duty to pay taxes on the income the corporation makes. But there are situations where the majority of a corporation's income is made off the personal services of its employees. For example, a law firm makes money by its lawyers performing legal services for clients. Oftentimes, law firms earn clients specifically because they want the services of a specific lawyer. Law firms are usually partnerships though, so this example is not entirely applicable. A more common example is an actor forming a corporation where they are the sole shareholder. Anybody wanting the services of the actor then negotiates with the corporation to use the actor's services. These corporations are often called loan-out corporations because they loan out the professional to perform services as an employee for the corporation, even though the professional might have been the one to form the company. They are common in the entertainment industry, especially in the past decade or so. It is impossible to logically apply the one who earns income is taxed for it test in this situation, because the corporation would never pay tax, and you would have to determine what portion of the income from a customer or client goes to which employee. Instead, the court articulates that the test in this situation is who controls the earning of the income. Two elements need to be met for the corporation to be considered the earner of the income instead of the employee, and therefore, the one who is paying the tax instead of the employee. First, the employee must be an employee, and the corporation must have the ability to meaningfully control and direct the employee. If the employee can ignore the corporation and tell them,
"You do not tell me what to do,"
when the corporation asks the employee to earn income somewhere, then you can't say that the corporation controls the earning of the income. Second, there must be a contract or agreement between the corporation and the person or entity using the services that recognizes that the corporation has a controlling position. The agreement must show that the corporation is the boss, and that the person procuring services knows that the corporation is the boss. Mr. Johnson contends that EST is the one who should be paying the taxes because it is one of these loan-out corporations, loaning out the services of Mr. Johnson as a professional basketball player. Therefore, he must show that EST controlled the earning of the income by proving that 1. Mr. Johnson was an employee of EST, with EST having meaningful control over him, and 2. EST and the Warriors had an agreement recognizing EST's control over Mr. Johnson's services. If he does this, EST pays the tax, and Mr. Johnson does not have to pay the almost $600,000 tax bill. Unfortunately, Mr. Johnson's dream of avoiding a huge tax bill sadly does not come to fruition. Instead, the court determines that Mr. Johnson is the one who controlled the earning of income and needs to pay the tax on said income. Judge Fay accepts that a contract was made between EST and Mr. Johnson, so the first element of the test is satisfied. The second element, however, involving the existence of some indication there is a relationship between the corporation and the entity using the services of the corporation's employee, and that the relationship recognizes the corporation's control of the employee, is held to not be met. Crucial to Judge Fay's decision is the NBA uniform player contract between Mr. Johnson and Golden State. Want to know why Mr. Johnson fought so hard to have a licensing contract instead of a personal contract? Well, this was most likely the reason why. Judge Fay notes that there was no contract between EST and Golden State. Instead, there were contracts between Golden State and Mr. Johnson and EST. There was no relationship between EST and Golden State, so how can EST control the earnings? There's this sort of employment relationship triangle, with Mr. Johnson being a middleman who earned the money from playing basketball and then sent the money to EST to drip feed it to him monthly. Even though all of Mr. Johnson's earnings were sent to EST, Judge Fay holds that this demonstrates the opposite of what Mr. Johnson intended. Instead of demonstrating that EST controlled the earnings because they received the income from Mr. Johnson's work, this situation demonstrates that Mr. Johnson did have control over the earnings. He could tell Golden State to send the money to EST instead of him. Even though he was contractually obligated to do so, it doesn't matter for tax purposes. In conclusion, because there is no relationship between EST and Golden State, Judge Fay holds that Mr. Johnson was the one who actually controlled the earning of the income from Golden State for playing basketball. Since he controlled the earning of the income, he should be taxed on the income. The IRS wins, and Mr. Johnson, unfortunately, must pay the almost $600,000 tax bill. I'm not sure how hard that tax bill hit Mr. Johnson, because he had been retired from the NBA for almost 3 years when this case was decided. I can imagine it didn't help his post-retirement plans, and Mr. Johnson did not take the tax court decision lying down. He appealed the decision to the Ninth Circuit Court of Appeals, where Judge Fay's decision was affirmed. The U.S. Supreme Court then decided not to take the case up on appeal. Simultaneously with this tax court case, Mr. Johnson filed in federal court about the same issue. He was similarly unsuccessful. After leaving the NBA, Mr. Johnson played tennis and golf, including playing in several tournaments. He would die of cancer in 2007 at the age of 58. Mr. Johnson was said to be a private person. Rick Barry and Clifford Ray, two of Mr. Johnson's teammates at Golden State, had no idea he had cancer when he died. I do wish that there was more information about Mr. Johnson out there. He seems like an interesting person. I also want to thank him for initiating this case, which assisted me and many others in my federal income tax class. Mr. Johnson's case shows us 3 important things about income tax. First, people will put a lot of effort into avoiding taxes. Second, on a more serious note, it matters who earned the income for tax purposes, not necessarily who received the income. Third, if you wish to start a corporation that will contract with clients who request your services, whether that be in entertainment, law, or some other type of professional work, make sure that the client contracts with the corporation and that it is obvious the corporation directs what you will do, or at least gives the illusion that it does. I don't know if anybody watching this video has the need to start a whole corporation to reduce their tax burden, but it's a nice thing to remember just in case. Until next time, I'm Lex Ursa. Have a nice day.